Welcome to USA Update, your fastest and most trusted source for breaking news from across the United States, from politics to the economy, weather alerts to viral trending stories. Social Security is the primary source of income for millions of retired Americans. For many, it is not just a monthly payment, it is the foundation that keeps them financially secure and above the poverty line. In 2023, studies showed that Social Security lifted approximately 22 million people out of poverty, including more than 16 million seniors. Without it, the poverty rate for older Americans could jump from around 10% to more than 37%. This highlights the crucial role Social Security plays in the lives of retirees, providing stability and a safety net for daily living expenses. However, recent policy changes, particularly under the Trump administration, have introduced new rules that could impact how much retirees receive. And these changes may have significant implications starting in 2026. Understanding these shifts is essential for older Americans to protect their benefits and maximize their income. During the pandemic, the Social Security Administration reduced the amount it could reclaim from overpayments, dropping the clawback from 100% to just 10%. This change protected retirees who had received overpayments through no fault of their own. However, in 2024, the administration announced a return to the 100% clawback rate. After significant public backlash, the rate was reduced again to 50%. Even at this level, it's 5 times higher than the temporary 10% rate, meaning that, honestly, many retirees who were overpaid could lose up to half of their monthly Social Security checks. This change really underscores just how sensitive Social Security benefits are to policy adjustments, and, it serves as a reminder that retirees need to be aware of how overpayments and repayments can affect their monthly income. Another major change involves the elimination of paper checks. President Trump signed an order requiring all remaining recipients who still receive paper checks to switch to direct deposit or a government-issued prepaid card by a set deadline. While nearly everyone already uses electronic payments, about 500,000 people had to make the switch or, risk delays or disruptions in receiving their monthly benefits. This transition is really important because electronic payments are faster and more secure. But for those who aren't familiar with the process, missing the deadline could actually create some pretty serious financial stress. Retirees need to make sure their information is up to date and that they've successfully made the transition, just to avoid any interruptions in their income. Trump's trade policies have also had an impact on Social Security. His tariffs on certain imported goods, they slightly increased inflation. So, while Social Security benefits can't actually decrease when prices fall, this temporary spike in inflation got, permanently built into the 2026 cost of living adjustment, often called the Trump bump. As a result, retirees' monthly checks will stay just a bit higher than they would have been otherwise. Now, while this increase might sound like a good thing, it also shows how policy decisions can really impact retirees' cost of living. It highlights just how complicated these economic measures are when it comes to long-term Social Security adjustments. One of the most pressing concerns for retirees these days is, honestly, the possible return of student loan garnishments. A lot of folks think student loans only affect younger borrowers, but, more and more Americans are actually entering retirement with unpaid student debt. Right now, more than 450,000 Social Security recipients have outstanding student loans. Before there was a temporary pause in 2024, the government actually had the ability to withhold up to 15% of a retiree's Social Security check to recover defaulted student loans, as long as the individual was left with at least $750. The Department of Education paused these garnishments for a few months, saying they would resume later in the summer. Even though summer came and went without the resumption, the pause was only temporary, and, a lot of experts predict that garnishments are likely to return in 2026. This situation is creating a lot of uncertainty and anxiety for affected retirees who really depend on their full monthly benefits just to cover basic living expenses. The good news is that there are legal ways for retirees to prevent student loan garnishments. One option is the total and permanent disability, or TPD, discharge. Retirees who are permanently disabled may qualify to have their student loans canceled entirely. About 22% of older Social Security beneficiaries with student loans report having a permanent disability, meaning a significant number of people could potentially take advantage of this program. Many, however, are unaware of their eligibility or have not submitted the required application, missing out on a major opportunity to protect their income. Another way to avoid garnishment is by applying for a financial hardship exemption. Over 80% of older borrowers in default meet the income and expense criteria for this exemption, but fewer than 10% actually apply. This simple step can completely stop garnishments, yet the low application rate highlights the need for increased awareness.